We are live on Oz Property Investors. We bring names, and we have the big fun and big data fun tonight. Matt's Jollikstrom Hashtag. Fuck, I screwed that name. Anyway,
it's all right. It is Matt. It is Matt. You can call me Matt.
Yeah, but it's the last name, mate. I just feel
No, you actually did it well. You actually did it well.
Oh, here we go. Just say it with confidence. You're already puffing up my feathers. How you going, man? What's happening? How's your day?
Man, it's been busy today. Working on a couple of reports. Busy as always, but I've been busy is good, so I'm happy about it. Overall, life is good. Life is good. Thanks for inviting me. Thanks for inviting me.
No, you're welcome.
Facebook didn't go live.
We are live. Facebook didn't go live though. So anyone that is on Facebook, apologize. You're not here. So Jeff, can you sort the admin of that? This is Oz Property Live on a Wednesday night. So there are sometimes technical difficulties while Jeff sorts that.
It happens.
Exactly, mate. I'm excited. I'm excited to bring you on. Your platform has been one that has been on my radar for many, many years now, and I've been kind of watching it grow and expand out. And I think it's now finally at a point that it's kind of like a holy shit. This is very interesting now. Let's see what's going on here, which is why we wanted to bring it on and kind of share it with the community, because data is becoming such a big piece of property investing. Like it's so massive now that if you're not doing the right things, you're going to be making some interesting mistakes. And the problem is when you're spending $500,000, a big mistake is an expensive one.
No, absolutely, yeah. Absolutely. I mean the title. Essentially, if you want to get to 150K, only one wrong decision can actually impact your trajectory, and you might not get there. So yeah, definitely, it's something that people are using these days. I mean, it makes you allows you to make faster decisions, allows you to triangulate and look at information from many different perspectives, and I think it's useful for investors. You can also do a sanity. You can also do a sanity check, on your biases. I think that's the most important thing, I guess.
A sanity check on your biases. Well, that's also something I wanted to do as well as a part of this session is kind of boil it down and break it down and to not be so complex and difficult and confusing, because I see a lot of people out there in the industry that are kind of hiding behind the data. This is the data. You can find out eventually if you use me because I have the data. So I wanted to kind of break down, well, what is the data and how can we as everyday investors work that stuff out for ourselves and use it in a way that kind of makes sense. Simplified, if that makes sense.
Yeah, absolutely. Yeah. So, I mean, just to add to that, I think you're correct. This data term has been thrown around in the industry a lot lately, and it sort of, protects us from or insulates us from, potential wrong decisions in the future. And I think that's the wrong way to approach it. The thing is, every data point is a representation of behavior. So every data point that you're looking on a page, it's actually humans walking on the street and exhibiting certain purchasing patterns. So I think data can be used appropriately if you have a lot of data points and if you understand how those many data points actually construct a story or a narrative that you can understand, and from that infer what is the behavior on the ground. So I think what's dangerous these days and what people do is they would make a decision on a particular data point, excluding everything else, whether, all the other data points. So usually people say, okay, just because something is grown in the last 3 years, that means it will grow more, or just because there are, building approvals, it means oversupply, or X, Y, Z, So they're essentially trying to construct a narrative from a single metric and overshadowing everything else. I think that's very dangerous. I think if you are using data, you have to triangulate and actually layer and put data in a type of a hierarchy that can be produced into a narrative that you understand.
Right. Yeah. Into a hierarchy. That's interesting. Yeah. Okay.
Yeah. The hierarchy is essential because, some metrics are more important than others. So you have macro narratives and you have micro narratives. And those macro and micro narratives all have different time frames. So you have... Sorry,
Johnny. I thought, sorry, Matty. I know you're on fire, man, but we were about to have to restart the stream. So I'm excited. For those listening to the podcast, we are definitely live. So Go on. So yeah, for those on Facebook, let us know you are watching. We should be live, but Matt, sorry to interrupt. What I want to do is for those who just joined us on Facebook, what are we here to talk about tonight? Because we promised 150K passive income portfolio and how data helps you to get to that stage. So we're going to talk about, well, how do you sort of frame it back the strategy and sort of link that? Because if you don't do that first, we'll talk about why that's important. And then we'll actually talk to those core data pieces that you need to consider, 3 to 5 that we've sort of promised. And then we're going to go to some locations. So please go on, Matt. Sorry, I interrupted you, mate.
No,
yeah, go on.
Well, coming back to your question on strategy, which sort of relates to what I was saying to Joe. I think it's important for you to understand the brief for the particular purchase, because that needs to fit into the overarching strategy. And the overarching strategy is, I guess, your way on how you're going to get to that 150K passive income in the future, whether that's 5, 10, or 15 or 20 years. So you need to deconstruct that overarching strategy and fit it to a particular brief for a purchase. And usually that brief for a purchase can be distilled into 4 different questions or answers to 4 different questions. And that will be, What is your budget? What is your investment time horizon? When do you plan to extract equity into the additional purchase? And this is what we usually delineate, such as, refer to as, do you want a hotspot or a warm spot? Because that affects your equity extraction time frame. And then what is your risk profile? When you have those questions answered, then that sort of informs how you filter, how, as I said to Joe, you construct a narrative, which metrics you choose over others, and what is the hierarchy that you employ to actually conduct further research.
So the one that I've got a question on is the risk profile. So that makes sense. Yield, how much cash flow, like yield does your platform require, does your portfolio require, the price range, and then what's the risk side of things? How do you determine
Yeah, that's a good question. I think a lot of people, so different people define this risk in a different way. To me personally, and this is my personal opinion, risk is everything that stops you from realizing your goals. So essentially anything that can impact on you realizing that 150K passive income is what can be classified as risk. And what is usually classified as risk in property investment is that which sort of stifles the growth of your portfolio, the growth in your asset values. And it's usually things such as industry centralization, exposure to mining, exposure to dominance of mining and agriculture, bushfires, flooding, or even higher renter to owner ratios. And see how I said now, I've mentioned 5 elements here, or 5 indices. Renter to owner ratio will be in a lower hierarchy to these above in the domain of risk, however, will still be important. For example, why? And again, what does renter to owner ratio tell us? What narrative does it elicit? So if you have higher renter to owner ratio in a particular locations where macroeconomic conditions change, so the interest rates increase, and then investors find it hard to hold on to those assets, they're going to start disposing property onto the market, which will potentially increase your supply and potentially, now it doesn't mean oversupply, potentially stifle, pull back, or dampen your price growth. So, metrics can be both positive and negative, can have inherent risk depending on their range. But I would say the primary 4 domains will be, industry centralization, exposure to dominance of mining and agriculture, as well as bushfire and flooding exposure, negative environmental effects. Because the first 2 can lead to negative growth, again, during changes of macroeconomic conditions, because those industries might be affected, and then they start letting off workforce, which has an effect on price growth. While the bushfire and flooding aspect is they can potentially increase your holding cost and be unfavorable. Those areas are unfavorable for investors to actually go in, which, if investors are not participating in the market, you don't have a compounding between owner, occupier, and investor demand, which doesn't lead to above average price growth.
Okay, yeah. So is there like a threshold that you think about for stats and data and things like that? Because like renter to owner occupier, what you're talking about there is, let's say there's 70% owner occupiers and then 30% renters. That would be 70-30. Is there like, oh yeah, as soon as it hits 50-50, that's when I'm like, hell no, I'm not going to go there. How do you kind of think about that? Yeah,
absolutely. So there are ranges within ranges. So if we look at, from a macro perspective, I would say that everything that's below 35% renter to owner ratio will be favorable. Anything between 35 to 40 maybe is edging on the neutral, and anything above 40. And now everyone works on different ranges, from experience, and different markets potentially could have different ranges. But if I wanted to give an overarching rule, that's what I would say. A 50% renter to owner ratio will be disadvantageous.
What about markets that have got a higher percentage of renters just naturally? Like they're like, for instance, Toowoomba. Toowoomba is a market that has overall 40 to, or like 35 to 45%, somewhere in between there as a general overall, but still a strong market, but has a higher owner occupied, a lower owner occupied.
Yeah. So now when it comes to research and analysis and picking an area, it's never about the one area itself in isolation. It's always in comparison to other opportunities. So if I'm in the business of increasing the probability of a particular outcome, i.e. increasing the probability of me realizing those future goals, and if I have two areas with exactly the same metrics, and one has a 50% renter to owner ratio, another one has 30, I'll pick the 30. Now, it doesn't mean that the 51 will not grow, but I'm trying to eliminate risk. I'm buying an insurance policy and I'm trying to make sure that I can sleep at night. So I'll pick the 30. Now, we don't know what's going to happen tomorrow, let alone in the next 10 years, but this is a prudent way of approaching a data set.
Yeah. I guess going back to like the one data metric that people focus on and how bad that, how bad that is. One of these ones that I keep hearing is the property market must not have grown it has to have grown less than 50% in the last 3 years. Once it hits that 50% mark, we don't buy there. That's the rule. 50%, it's gone in 3 years. We're stopping, or we're all out. We're all done. What are your thoughts on that?
Yeah, I hear that as well. And I think I can talk about this for hours, but let's distill it first. So first, I think it's very dangerous to, and we said this at the beginning, I think it's very dangerous to reach a conclusion about an area from a particular metric. Another thing that I would like to say, growth patterns across different timeframes are just an indicator, but they don't actually lead to growth itself. So if you're analyzing an area, you need to understand that everything functions on economics. And what are economics? Supply and demand dynamics. So the fact that an area, for example, has grown 50% in the last 5 years, the area might still have reducing supply and increasing demand, which means it will grow more. So this making a decision purely on the growth patterns without actually analyzing the supply and demand dynamics is inappropriate, because you're completely, essentially walking blind into a decision.
Yeah. It's not.
Sorry. So I'm not saying that those kind of. I'm saying actually, I'm in favor of trying to analyze as many data points as you can, and I sometimes even get overwhelmed. I actually sat down today and I did a report for a client. I analyzed 40 suburbs across 80 metrics. Okay, so, and it is a very onerous process. Now, I'm in favor of actually layering and putting additional information so I can actually triangulate and make a better decision. But, you have to understand how growth works. It works from simple economics, and making a decision purely on growth patterns. Growth patterns are just an indication of a cycle. But that cycle could continue, could dampen, and then the question of time frame. Let's say an area has grown 50% in the last 5 years. Well, it might have another 20 or 30 in the next 2. So if your investment time horizon is short term, i.e. you buy and flip or you develop, well, that area could be a potential, investment opportunity. Now, going back to the strategy and the brief, it all depends why you want to participate in the market. So saying that we shouldn't invest in an area that has grown 50% at all, it's just, it doesn't consider the individual circumstances and also the supply and demand dynamics that actually lead to growth.
Yeah,
you might have different time frames. You might have different time frames. You know what I mean?
Yeah, I was looking at on the platform, trying to kind of find and illustrate this point a little bit more. This is a suburb here that at the 3 year. So if you look at the 1 year, this property did 46%. And if you bought this, if you're like, oh my gosh, it's run out of steam, you would have missed out on when this property hit. Over 3 years, it's done 107, right? So for me right now, no, do not buy in this market, because 107, and obviously you have to look at the rest of the data, is pretty aggressive. You're going to have to look at the affordability. Can these people that live here from 2023, the price is down here, it's now up to the 800, so 500 to 800. That's massive. If you cut out at 50%, you would then have 57.4% that you have missed out on because of that one metric alone.
Correct. Correct.
Which
And you said the right thing. I mean, it's very important to determine the steam of the market. And the steam of the market, again, relates back to how long do you want to participate in the market. And in order to determine the steam, let's say you want to participate 4 years, you need to figure out, okay, is there 4 years of steam left in this market? And you said one thing, you would layer affordability, you would layer supply and demand dynamics, metrics, and then furthermore, hold periods, these other risk factors such as renter to owner ratio, etc., just to see if there's actually more steam in the market. And again, as I said before, the question is not about that market in isolation, but let's look at other markets if they give us a better opportunity as well in comparison to that one. But simply making a decision or a call on growth patterns, as you rightly pointed out, if you had the 50% rule, you wouldn't have invested after the first year and would have missed 60% growth.
Yeah, ridiculous. I think we're all worked out the tech. We're just going to go live on YouTube, Facebook. We apologize, but I hope everyone from Facebook has jumped on. So what happens if we yammer on for too long? We're chatting to Matt off air, and then once it goes past 10 minutes, it destroys itself. So apologies.
Yeah. That's all right. I will do a replay. So if you're watching on Facebook, Matty is an absolute beast. So if you're watching this, so I'll do a live replay tomorrow night. So drop your comment if you're watching the replay, and I'll make sure Matty answers as many of those as possible. So I want to introduce, because we haven't even introduced the guest, who is, for those people living under a rock and haven't seen him floating around, you are, sorry guys, I was trying to sort out the tech. And then conversation, it's just been amazing. Like these are the kind of conversations so if you have questions about data, if you've ever been curious, make sure you ask those. And we're going to talk to areas as well. So stay tuned. But you are the head of research and co-founder of HTAG, which I'm excited. It's all about cutting through the hype and the noise, because there is a lot of noise and information out there. And it's who do you trust and who to go to, and how do you know what information is sorting the wheat from the chaff? So your mission as well is to help investors navigate the market with confidence, to sort of avoid the herd, which I think is a challenging thing. So you as well, you are an author, a property investing coach, and you've done a PhD. So you're a doctor. You didn't put doctor in your name as well. So
who would have thought?
No, I mean,
my mum can't even believe it.
Philosophy, is it? Or that's
yeah, you get a doctor of philosophy, but in Australia, when you do a PhD, you get a doctor of philosophy. Anything you finish, even if you finish medicine, for example. But I did organizational psychology for my PhD.
Wow, organizational psychology. I did a bit of HR and org development in my undergrad. So, man, I think I never worked in that field. But anyway, so we're gonna skip through. We do love usually asking people what got people. You are so passionate, I'm sure we'll see that go through. We're not going to ask you what the reason you got started in the property industry. I'm sure it's a cracking story, but ask him offline maybe. But I want to know, to solidify what you guys are talking about there about sort of the sort of growing, I want to know what sort of people, how do you link that sort of data side? What are the key things that go into the data side versus the strategy? And because that, if you make a mistake, as Joe said, that can really set you back. So what are the sort of key things one of them is risk tolerance, but the other things, what are those couple of
so first you have to know the budget. And I mean, budget is very important because budget allows you, gives you information on what you can actually get. This is why I'm actually averse to the notion of hotspotting, because a hotspot for me is not a hotspot for you, simply because if you have different budgets, what good is it for me to invest in the 800K area when I have only 500K to spend? So, and when you have a particular budget, there's an economic underpinning to that budget as well, which allows you to extract certain average from the market. I mean, I speak to investors on day-to-day basis, and sometimes they come to me and say, Matt, I want to invest in a 350K market, but I want 8% average growth for a decade. That's not going to happen. So it's just because the economic underpinning of that area is insufficient enough to generate that growth. If it was, it wouldn't be 350, it would be at 800K. Now, don't get me wrong, the area will still grow, but I'm talking about, 2 or 3 or 5% above average, which is 5 in Australia, and you're expecting that to happen for a decade or 15 or 20 years, So you have to give some leeway and understand that budget provides boundaries from what you can achieve, Now, you can, lower budgets means lower risk, in a sense, lower risk as in lower financial outlay. But you have to understand that, sometimes you can't get 8% yield and 15% growth annually. Then the next thing that I always ask for is the investment time horizon. That sort of relates to what Joe and I were discussing, what I was saying to Joe. Depending how long you're in the market will dictate, what metrics are important and what areas you can pick. I mean, investing at the top, at the peak of a hotspot is all good and well for those who are renovating, because they're going to hold on to an asset from 12 weeks to 6 months. So they don't care. I mean, they want to leverage the market momentum and dispose of that asset right away. So the fact that it's at the peak of the hotspot is actually a preference, But if you're in the market, let's say for 5 years, that means that you want to leverage the full extent of a hotspot. Hotspot lasts anywhere between 1 to 4 years, which means you want to enter a little bit before, leverage the full cycle of a hotspot, and then exit. But if you're 15 or 20 years, then again, the approach to the market varies. You don't care how much you, make instantaneously. You approach data in a different way. So it just all depends on time frame. I need to know that. The third thing that I need to know is, when do you want to extract equity into a subsequent purchase? And this is where it comes to gray zones between cold spots and warm spots, between warm spots and hot spots. What I mean by gray zones is you get clients who don't want to enter a hot spot because there are negative hallmarks associated with it, such as the inability to actually find appropriate real estate, the ability to find real estate that's priced accordingly. And you're fighting or elbowing your way through with 10 or 15 buyers agents fighting for the same property, even 30 in some instances. So if you want to extract your equity, this is what I need to know. So sometimes clients come to me and say, listen, man, I don't want to enter a hotspot, but I do want to extract equity in the next 3 years, or have the ability to extract equity in the next 3 years, which means that we need to align the data in such a way to position the client to enter a market which will become a hotspot in the next 2 to 3 years. So usually a warm spot generates anywhere between 0 to 5% growth, and a hotspot is 10% plus. So when you compound all of that, you might be looking at 30, 40, 50% growth in those 3 years, and then the client can extract, So the timing matters. The timing when it comes to extraction of equities are also very important. And then finally, as we said, it's the risk profile. And risk profile essentially relates to timeline. If your timeline is very short, you can be very, very relaxed with risk. So essentially, the question 4 is essentially a bit redundant, because it relates to question 2. What is your investment time horizon? So if your investment time horizon is short, you can invest in a centralized mining town. Now, you have to hope and pray a little that, the mining town is not going to be affected in the next year, but usually it's not. Usually you can see the macroeconomic changes happening. If the interest rates are going down, we don't have issues with China or whatever, you might not see an impact within that year. So you can invest in those rampant hotspots such as Rockingham or Gladstone or whatever it is, that have high long-term risk, but because you're in it for short-term, you don't care. You get in and you get out. So that's what I need to know in order to layer metrics.
My perception, and it might be wrong, is that you can reliably look at data 3 to 5 years out. Is that correct, or is that a myth? Like how reliable, or just like high reliability at least? What do you sort of think about that? Or how do you think about that?
Yeah, so data comes in many different time frames. Every metric has a different time frame associated to it. And I think it's important in data analysis to establish trends. And it's particularly important in context of property, because property is a liquid asset. And what that means is it doesn't exchange hands on a regular basis like crypto and equity do. And because it takes a long time to sell property, changes in trend or substantial changes in trend that are very sudden are potentially non-existent. So when you establish trends in certain metric, you can actually infer what is going to happen in the future. Now, the second part of that answer would be, okay, but how long into the future? Now, if you usually have 4-year trends, for example, for supply and demand dynamics, you can definitely infer into the next 2 years that those trends will happen, and you allow another 2 years of contingency that, you can play around with, You shouldn't infer that it will be the same in 4, because, for example, for a trend to shift, it takes maybe 1 to 2 years. So that's why I give myself that contingency. And then if you're a long-term investor, you layer first the short-term metrics such as supply and demand trends. Once you establish that, you know what's going to happen in the near future, then you have to layer those midterm and long-term metrics. And there are midterm and long-term metrics that indicate, and midterm and long-term metrics are not future inferring essentially, but there are stability metrics. You look at metrics which highlight market stability and resilience. Like, for example, as Joe has mentioned, socioeconomics, especially for higher price points, hold periods, affordability indexes, renter to owner ratios, all these other things, or growth rate cycle. See how the growth rate cycle is behaving, whether it's too sporadic or volatile, whether it's spent a lot of time in the negative growth zone before. Anyway, you layer all of these other stability factors, again, to increase probability, because the certainty doesn't exist. but like higher levels of increased probability do if you layer it appropriately.
So what you're trying to do is remove as much uncertainty as you can, and slowly but surely layer on more probability.
Absolutely. That's the name of the game. That is the name of the game. And then obviously the last aspect of you winning is, as you, Joe, as you would know, is, picking the right asset, adding value if you can, taking advantage of certain disparity in pricing, renovating, etc., etc. So this is where you layer and compound. If you find a market that has good short-term dynamics, has good stability dynamics, so you've established a market momentum that's favorable for your strategy, and then if you compound that and amalgamate that with the appropriate asset selection, you're winning.
Yeah, I like that. That's kind of stacking the odds in your favor,
Absolutely,
so to speak.
Absolutely, it's stacking, exactly.
I'm going to ask a bit of a spicy question. Maybe it's not spicy. I'm sure you get asked this all the time. So Dave has asked, "Hey Matt, how do you know source data Hashtag is using is reliable?" I'm sure you get asked this all the time. So I hope it's not
absolutely. Yeah, we're very big on that. Yeah, so now, I mean, you do have APIs that can be bought these days from big data providers, Domain, Real Estate, CoreLogic, all of the other big companies. And we purchase data from multiple sources, not just one. We spend a lot on data. We care less about our profit margins. We care more about the accuracy. So we spend a lot on data. We acquire it from multiple sources, and we clean our data and publish it every last day of the month at midnight. So how accurate and reliable it is, well, you're acquiring it from all of the sales volume of all of the big corporations that collect data. That data is even used by governments, by the way. Now, how up to date it is, well, there's a month lag, but as I said before, because property is a liquid asset, that's essentially instantaneous if you want to speak in equity terms.
Yeah, love that transparency.
There's a great question that's come in here, and anyone that does have any question, throw them in. But does Matt have a solution to the blue chip or blue collar argument? Because I guess I'm more interested about this last point. What price point do you see value at in the next 3 years? Like, what do you see more value in the low end of the 400s to 500 to 600s, or do you see the 600 to the 900? 600 to 800 or 800 plus? Like, is there a sweet spot going forward into the future?
Yeah, I think that's a great question. And I was actually thinking about it for a while in the last couple of years, seeing all of the briefs that are coming in. Now, 9 out of 10 briefs that we receive, for example, are in the 550 and below range. Sometimes
95%.
550 and below.
95%.
9 out of 10 briefs that we receive. Can you hear me?
Wow. Yeah. 9 out of 10.
Yeah. In that lower range, because I guess people want to get onto the property ladder, but it's expensive. So I sort of understand, which is why this notion of affordability is very important. It will be important for the next decade to come, definitely, or even more. I personally believe, and this is my opinion, I think that the sweet spot is the 600K range. And when I say range, I would actually say 600K, because usually what you get in those at a 600K. You usually have areas that have very sound socioeconomics and very sound stability factors, and yet they are within reach for both investors. I mean, investors can stretch their budgets to 600, and they're also very desirable areas for owner occupiers. And I think, and we had a lot of members who've been buying in that range and making substantial returns. And if you layer the metrics appropriately, you can find an area at 600K that can get to that million, you know what I mean? Or get to that million and more, has the potential to do that. So I personally believe that is the sweet spot, because, for example, if you buy under 500K, usually, again, budget informs what you can get, and usually those are the areas of lower socioeconomic standards. Now, I don't want to put high primacy in socioeconomics, but I'm just using that metric because it's pertinent for this argument. So usually the 500K areas that have lower socioeconomics and some instability factors, and it's very hard for those areas to get to $1.2 million mark. Now, some do, don't get me wrong, but I'm saying on average, it is very rare to see an area with $1.2 million typical value that has an ersatz of 1. Very disadvantageous socioeconomics. So with the 600K range, you have best of both worlds, and it can give you that pump past the 1 million. So I would we buy in the 600K range, and I would always buy within that range.
How's that sort of changed in the last, because you had sort of locations in your Brisbane, Logan, your Armidale over in Armidale region, Gosnells, Rockingham. How's that? Would you say that in 2020 that would have been slightly different, or how's that evolved over? Because you guys been around since 2016, 2017, so you've been around a while. So how have your thought process changed on that, or has that stayed similar?
Well, some of those areas that you've mentioned, I think, and this is why they're going to hit a friction point. Some of those areas you mentioned have had an enormous pump and have reached an 800K typical value, but are still of low socioeconomic standard. And they're hitting that sort of friction point where it becomes a question mark. Okay, how much steam do they have more left in the tank? I think I think it's actually intensified, and I don't think it's actually defined by the area itself. I think it's defined by macroeconomic conditions. I think with the increases of interest rates and erosion of purchasing power, I always talk about my Coles shopping trolley. When I moved to Australia, I could feel a shopping trolley with $50. Now it takes me 300. So now imagine what happened to property. So I think because the macroeconomic conditions are changing, while property still remains in Australia one of the biggest asset classes, and people still want to get onto the property ladder, they're sort of diverting towards that lower price range.
Yeah, because I suppose the question's more leading, yes, maybe that was that stage a couple of years ago. How do we know when that 600 sort of price point then goes to 700 or 750? Is it then, how do you assess that sort of side of things?
Well, as I said before, you need to layer the short-term and long-term metrics first, the supply and demand, and then stability. But you can also, our platform is not only used, or I don't use it personally. I don't know whether people use it in the same way. I don't only use it to anticipate what's going to happen in the future, but I use it as a research tool. As in, I want to see what has happened in the past. So you can see $1.2 million areas that have had 100% growth in a decade. So they got there from 600, or, I'm not allowing for compounding here, but you know what I'm trying to say. So it takes 7 years to compound to double. Yeah. So it does happen. And then you go back and you see, okay, what about this area then has made it get there? And then you look for these stability factors. And this is how you actually find out information. I think people should really use any data source, any platform. Doesn't have to be HTAG, but any data source that provides you with historical pattern and with historical information. You can use what has happened in the past to actually find out some rules and patterns that you can employ to use for future research. Now, a lot of people say,
that's such a great point. That's such a great point. So many people should do that because they looking at the future. They don't assess, well, how did this $1.2 million property market get to that $1.2 million property market? What is favorable of it? What are some of the things that you've seen that you've been like, whoa, didn't expect that, or was it a bit of a surprise for you?
I was surprised that Bunbury, for example, has reached 800K. Considering it's low ERSAD and low data volumes. I'm very surprised about that. I think it's going to come off a cliff. That was a surprise. Now let's see. I'm live here, so remember this.
The data points that you've seen that you were surprised that led to, for the $1.2 million property markets that have grown, what are some of the things that you've noticed, the trends that they have that other markets don't? Is it the ISAD?
Yeah. So it would be, okay, it's the ERSAD, socioeconomics, essential.
Sorry, we've said this word ISAD, ERSAD. Can you explain what that is, the definition?
Okay, so let me just pull up an exact definition. So I'll read it out. So it is, ERSAD stands for Index of Relative Socioeconomic Advantage and Disadvantage, and is published by ABS. The index defines people's access to material and social resources and their ability to participate in society. So that's so essentially Index of Socioeconomic Advantage and Disadvantage. Now, what all of those markets, the ingredients that they have very highly diversified industries that have very high, they have above average socioeconomics. They have very high hold periods, i.e. 8, 9, 10 years hold periods, which signals livability. They have lower renter to owner ratios, and they have very stable growth rate patterns, i.e. they don't traverse into the negative territory a lot and many times. So those are the patterns that are usually exhibited in those areas that had 100% return in a decade. And that's how you actually define, that's how you create rules. You create patterns from a data set, And then obviously for the short-term performance, as I said, all of those areas have had a scarcity in supply and an increase in demand, back at the time when it was growing. And then usually demand tapers off and goes through a cycle. But even when it reverts back to the mean, those areas that revert back to the mean is above the zero line. It doesn't actually go into the negative growth zone. So it's actually always growing and compounding. It never actually goes below zero.
Yeah, interesting.
Can I ask a potentially, I wouldn't say controversial, but just there's this another debate out there, the blue chip versus blue collar debate. The other one that people talk about, and I kind of think it's a combination of both, but it's that time in the market versus time in the market, timing.
Ooh.
How do you think about sort of that? I think I'm on team timing, because if you hit time in the market and how do you kind of deconstruct that in your head, Matt?
Yeah, I think we shouldn't think in terms of opposing theses. Sorry, I think that they should be looked at two sides of the same coin. So it's both timing the market and timing the market. I do think that timing the market, especially now, it's interesting. Investment time horizons have also shortened. People are not buy and hold 15 years anymore. We have a lot of customers who want to get out of it in 5 years because of their circumstances, essentially. And I do think because everything goes to cycle, it's really important for you to actually time the entry point so you can actually leverage the full extent of the hotspot and the growth. Think about it this way: if you go in at the top of a hotspot, you're at a peak. So essentially for the next maybe 5 or 6 years, it's going to be stagnating and reverting to the mean. Yes, you're holding 20 years, it's going to go back, but you've actually cut off that full upward swing and it's not in your pocket. You know what I mean? So I do believe that timing the market is important, and that's done by essentially understanding the supply and demand dynamics, but time in the market as well, because compounding is the eighth wonder of the world.
Yeah, that's a great answer. It's exactly that. It's a mixture of taking on both. A bit of a random question it's out of the blue, and I feel like we had a bit more structure to this session, but you just answer these questions so well. What's your view of property investing over the next 3 years? Like, we've had a massive growth cycle. Some markets, as I just showed, have grown 107%. Like, what the hell is going on? Are you bullish? Are you scared shitless? Like, how do you think about property investing for the next 3 years?
Oh, that's a deep question. I'm bullish. I mean, I'm bullish simply because, again, everything moves through cycles. And while one area grows, the other one stagnates, and we've seen that from the WA Victoria dichotomy. So you can take advantage of counter-cyclical investing always. I do think that we're sort of at the precipice of another interest rate reduction, whether it's now, next year, in 2 years, but essentially the debt cycle is essentially changing. So they're going to start printing money, which is allow for, I guess it's going to be cheaper to buy property, which should, inform market growth. I do think that population is growing in Australia as well. Obviously, higher population levels, bigger demand. Now we do have an issue with the aging population. So that might affect patterns of downsizing, etc. But overall, I think because Australia is importing people, essentially, population is coming from externally. I don't think we're going to have an issue with the aging population and the fact that interest rates are going to go down. I think we will go through another round of growth. Now, it all depends where. I don't think that every area will grow equally. Some will grow more, some will grow less, some will not grow, but yeah.
Yeah, it's interesting because I think that 2-3 years ago, you could throw a dart at the map on Australia and get whatever the hell you wanted and it would work absolutely fine. My belief is those days are gone, that it's not that easy anymore. The government printed billions and billions of dollars. You could just go to WA, throw a dart. You could go to South Australia, throw a dart. Queensland, throw a dart. Victoria, don't throw that dart. That's exactly, it's a perfect example. And the reason why you could throw a dart, and a lot of businesses, and good on them, have built a substantial financial base from that period. You know what I mean? I think good businesses and good buyers agents or good investors are seen when the times are hard, not when they're good and easy, So, government is not going to print as much money as it did before during COVID. I don't think it will happen. However, the interest rates will come down. So, and as you said, doesn't mean they're going to print money.
No, it's going to become easier to borrow. But however, they're still printing, by the way. They're printing all the time, not to that extent,
Yes.
which is why I'm saying the shopping cart analogy. This is happening because of debasement of currency, because they're printing constantly, and the dollar actually has less value, intrinsic value. So they are printing constantly, and the interest rates will go down. Now, there are two opposing things, and we don't want to get into economics now, but it's going to become easier to borrow and purchase, essentially. But yeah, during COVID, I mean, it was, you had handouts everywhere, people were making money, and good on them, you know what I mean? And even at that time, some areas weren't growing, as you rightly pointed out. So some were pumping, some weren't that much,
I'm going to transition. We're 40 minutes in. We need to, otherwise we got so many locations. So stay tuned. We're going to talk to Geelong for a little bit, and then it's going to be a sneaky one in South Australia, and then we might go to a hot earth spot just to contrast. But I want to know, Ricky has asked and answer. He said, what are the 5, and this is not, you could do a whole session on this. What are the 5 most important or most interesting, if somebody's just landed on planet Earth from wherever they landed from, Mars or whichever planet, and they ask you, Matty, what 5 data points not the free boom, the 5 boom data points we should be looking at, or the more important things if you don't know anything to start off.
You can only go. You're stuck on an island. You need to work out the price of property. Here's 5 data points. Which ones are you taking with you?
Yeah. See, I'm a bit. What's the word that I like and don't like those questions, and I'll tell you why. Like, I answer them straight, so I don't want to, weave around it. Essentially, essentially, it's supply and demand. You need to establish a scarce supply, and you need to understand that demand is increasing. And what are the data points? Stock on market, inventory, building approvals, hold periods, days on market, vacancy rates. That's 5 or 6. That's 6.
Yep. So hold periods, I think, is probably the least like that's an important one, but you're not like buying specifically based on that. So I had to include the hold periods, and I'll tell you why. Because if I give you all of those other ones, you have only short to midterm understanding. But if you include the hold periods, you're going to have a longer term understanding of the area. So do you see a correlation between those $600 to $1.2 million markets that have jumped to have longer hold periods as opposed to?
I mentioned that. Absolutely. So I mentioned, the markets usually exhibit very high hold periods, decent socioeconomics, lower renter to owner ratios, very high affordability for a particular price point, and also a growth rate cycle that is not sporadic and spends a lot of time in the negative growth zone.
Okay, so let's hit those 5. So we've got supply and demand.
Stock on market, inventory, building approval ratio. So that's future supply in the next 2 years of new dwelling. Then you have on the other side, it will be days on market, and let's say vacancy rates. I would also throw in hold periods just so you can have a longer term view to understand whether people actually like to live in that area and retain property. But I'm bound by 5, so I'll give you those 5.
Yeah. So hold periods is that important to you? That was very interesting. Yeah. Fantastic.
Yeah. I mean, again, you have to layer the short to midterm metrics and then long-term metrics. Like, you have to understand the stability of the market. And it is also a supply metric, because let's say hypothetically the hold periods are very short, 5 years. That means that every 5 years there's new stock of new existing dwellings coming to the market because owner occupiers are disposing it. And that can actually have an effect on price growth as well. So building approval ratios, it's a temporal representation of supply, in a sense that inventory, for example, as I said, it has a time aspect to it. Inventory is like average months of supply, so it has a bit of a past element to it. Building approval ratios are supply of new dwellings in the next 2 years, current building approval ratios, and then hold periods are supply of existing dwellings in the next 7, 5, 6, or 8 years. So you have to establish scarcity in 3 different time domains, so you can be sure that your property will compound. You're not going to have sharp deviations to the downside when it comes to growth.
I want to ask a bit of a micro question, and I haven't dived super deep on. I looked at your platform, but I want to know: are you able to sort of differentiate between at the street level, or are you mostly sort of how do you break up? Should we look at how do you break up hashtag? Are you purely at a suburb? Are you at a what does that look like?
We go down to the suburb level. We go down to the suburb level. Now, with data sets, what's important is, in order for anyone to use any kind of a data set, you need pattern. You need pattern, and in order to get pattern, you need volume. Yeah. And when you go down to the street level, it's very hard to generate a sufficient and substantial volume from which you can develop a pattern. So, I mean, there are other platforms and other sources that provide you information with the street level. I mean, I always go and sorry, I'm not, it's not my craft. I'm not a buyer's agent, but, inspecting houses, understanding where they are, staying away from those outliers. You know what I mean? Sorry?
Boots on the ground, some would say.
That's it. That's what allows you for that street level information. Bottom line, most of the growth that you get in an asset is from the area or from the suburb where it's located. And there's been a plethora of research published on that. I always say, you can buy a great property in a shit area and you still see minimal growth. So once you have, that kind of suburb analysis done, the rest is boots on the ground.
Yeah, I like that.
There's a good question that's come up here. There was a recent alert out by McGrath Report 2025. They're talking about baby boomers. Now, baby boomers hold $4.5 trillion worth of wealth, and $3 trillion of that is tied up in property, which will be investment properties or their own owner occupiers. 700,000 baby boomers will retire between 2023 and 2028. So these people need to go somewhere. They have large assets, and many of them are kind of downsizing. So, like, what are you seeing in townhouses versus houses? Like, do you see a shift in asset types that people are going for? Do you say, hell no townhouses, no units? Or how do you think about townhouses versus units?
Yeah, so on our platform on H-Tag, we only have houses and units. And by units, I mean apartments. And the reason why we have that is there's not sufficient volume across Australia when it comes to sales of townhouses for us to actually develop metrics and, again, illicit pattern. Townhouses or purchasing of townhouses is more pronounced in Melbourne. However, even that is sporadic. So I can't really say, obviously there's not sufficient volume, which is why we can't extrapolate our data set, which is why I think the shift has not occurred, or there's not a rising preference for townhouses now. Whether that's going to happen in the future, maybe. When it comes to downsizes, it doesn't have to be downsizing to a townhouse. It can be downsizing to a smaller house. So I wouldn't infer that downsizing inadvertently implies townhouses. Overall, I don't have an understanding of townhouses and the relationship between, because, as I said, across Australia, if you look at it, sales of townhouses is much, much, much lower than sales of standalone homes.
Yeah.
Sorry?
You don't have enough reliable data for Melbourne
Correct,
and Sydney.
correct.
Right?
So I can't really tell you, I can't really speak about an understanding of historical performance and pattern in those terms.
Yeah. So in terms of in terms of units, like one of the big debate is what grows more, houses or units? What is the data kind of telling you? Do houses grow more than units?
Well, I think from an accounting perspective, house depreciates, land depreciates in value. So I think the land component in houses is always that which, gives you that bit of a bump or pump. If we're looking at the data set, houses grow more. Now, you do have certain areas like Terrigal, for example, where apartments have been doing phenomenally well and have generated maybe 130, don't quote me on it, but above 100% in the last decade. Now, it is very rare to find, if you look at two data sets and you say, okay, how many 4-bedroom homes or 3-bedroom homes have generated above 100% returns in a decade, you'll have a big bunch there. While on the other side for apartments, you have, a much smaller company there, a much smaller group.
There you go.
Yeah.
I like how it seems like you've actually thought through all. Have you just got your own little cliff notes, so you think about all you just do some research? I'm like, that's amazing. You come up with a very smart answer to a lot of these questions that Joe's just throwing at you. It's like we haven't actually planned them. But I like that.
No, it's not. Yeah, I just been doing this for a while. That's all it is, guys. I just
it's not your first rodeo. This is an interesting one because somebody, Fani has asked, some people used increased sales volume as a leading indicator for upcoming hotspots. What's your view on this? I mean, I've got a view, but I think you've probably seen. Yeah, what's your view?
I mean, that's an interesting now sales volumes in and of itself does not mean anything because it's not contextual. And why it's not contextual? Because, for example, you can have a town that has 10,000 dwellings and it has a sale volume of 100, let's say on an annual base, hypothetically, and you have a town that has 5,000 dwellings and has a sale volume of 90. obviously the sale to dwelling ratio is much higher in area B, which means there's much more intense long-term demand in area B. So my suggestion is always to turn any metric that you can into a ratio to make it more contextual. When it comes to sales, it will be sales to dwelling ratio.
Okay.
And it's kind of I mean it's interesting, like on the price increase point, like people throw out, like do you look at percentages in terms of, like, so let's just say an area has grown 100%, but it's gone from 200 to 400k, that's 100%. But if somewhere grows 1 million to 1.3, that's only 30%. But the area B has grown by 100k more. So how do you kind of
well, it comes down to, cash on cash return. It's always bigger at higher price points, So again, it all depends. And what I mean by cash on cash return, if you invest 100k into a 400k property and 100k into a $1 million property, 5% here for 1 million is bigger than 10% here for the 400, on cash and cash on your investment, I haven't calculated that. I'm bad at maths, but I think I've got it right. I mean, it comes down to your price point and what you can get. And it comes down to putting pen and paper together, Like if you can afford the property of 800k and you get, let's say, less than average growth, but that less than average growth gives you a much higher cash or cash return, you might be happy. Now you have higher head risk and higher holding costs. So when I say higher risk, higher holding costs. Now, you have lower holding costs for a 400k property and doubles your value, but it gives you less cash on cash return. So, again, personal strategy, personal circumstance, pen to paper, always.
Yeah. I like that you link it back to that, because that's what I imagine would stop a lot of people from building that large portfolio, that kind of 150k, because otherwise, you could sort of celebrate going from 100 to 200k. But if you could have actually bought that 400k asset and that grows 50% versus 100, 50% of 400k, that's 200 compared to 100. I know which return I'm sort of after, and then you kind of potentially recycle to go into that next asset, rather than if you're probably taking 50k out of 100% growth. So I like that you think about that. It's kind of very much aligned.
Yeah, I mean, it's great that you're doing what you're doing there, because you're actually making people think a bit more. And that's what I'm all about. You have to critically think about what you're going to do. And sometimes what looks good on paper might not actually be good for you. So, for example, sometimes you might make more money, tangible money, with less growth, but you're investing at a higher price point.
Yeah. How do you think about that? Like, is there a frame that you kind of consider when you looking at those type of numbers?
Well, again, I'm bound by what I can spend. If I can do anything, I can buy the 800k and the 400k, and I have to choose. Well, essentially, it will be pen to paper to see, okay, how much return can I get within X period of time, and whether I can hold that property. And if I can, I'll always go for more cash outcome personally, because that's what we in the game for. You know what I mean?
Cash flow or capital growth.
As in. No. See, this is the thing. I will go for a bigger ROI as opposed to bigger growth. So a return on investment is more important than actually whether you make 10 or 15%. You can make 5% on $1 million property and 10% on a 350. You still make bigger ROI on the $1 million property. I mean, cash and cash. Yeah.
I think that this is super. Just to illustrate this point a little bit further, we have the Deal Crunch calculator that we have on our newsletter. But like, if you look at this overall, if you've got a property that you've purchased for $700,000, let's say the rent's $580, and it has a capital growth of 7%, total expenses of $12,000 per year excluding interest. If you've got an 80% loan at 6.5%. That rent is $30,000. The capital gain is $50,000. So the interest is $36,000. You're down $20,000 every single year, and that sucks. But you're net up $29,000 because the growth has gone 7%, 7%, 7%. So if you can continue that trajectory, like what Matt is talking about here, this is the number that he focuses on. But you need to be able to afford to hold on to this Correct. Negative cash flow. If this money is too much, it's not going to work for you. You're going to end up getting the negative $20,000 and not be able to hold it long enough to get the $30, $60, $90, $120,000.
And there comes the issue of higher rent to owner ratios.
Here we go, and that's what Tim
says. They'll start disposing it, and
he has hit that nail on the head, saying we're bound by what we can spend, quite literally. Good have gone on you, man. You're dropping some absolute value bombs here. So I want to ask one more, and we've probably unpacked, we've in bits and pieces talked to this, and we'll get to the areas. So stay tuned. But I want to know, how can we start to tell when, and I think they don't know the answer, but I'll ask anyway.
Yeah.
How can you start to, when an area is one you start to reconsider buying? Like, let's just say, like, not necessarily how much growth it's seen, because that's just one metric of many, versus ones we should start buying. Like, so reconsider buying versus start buying. Like, how do you think about what metrics are vital for that? Almost like a momentum kind of situation.
Sorry, so which ones we should start buying?
Yeah, or I'll simplify.
No.
Let's forget the which ones we should stop buying.
Stop buying. Yeah. So which one?
Stop
Yeah.
buying. Let's talk to both. Let's talk to both. But let's say, what are the indicators that tell you, hey, this market is probably time to leave market. Let's not jump into this one.
Yeah. So I will first establish a friction point with affordability. I want to see whether the market remains affordable for owner occupiers. If the unaffordability is high, I know that at least one cohort will start waning off, which is the owner occupier cohort, and you need both for above average returns. So once I establish that friction point or lack thereof, I would move into the supply and demand dynamics, and it's either or. I mean, I can either see an increasing supply and a demand that's not actually.
I don't think I'm a silly person, but I lost all of that. Can you just say that again? Because a friction point between affordability. What do you mean?
Yeah. So if the area is becoming increasingly unaffordable,
okay, to the demographic
and unaffordable for its residents, because the affordability index that we use is established on the median values within a particular suburb. So if it's becoming unaffordable, it's becoming unaffordable. First and foremost, for the internal demand, i.e., the owner occupier, its residents, that's the friction point there. So imagine a bottleneck. That means that less and less owner occupiers will be participating in the market because it's becoming too expensive to do so. Mm-hmm. So that's the first friction point. Then I would look at that. Then I would look at the supply and demand dynamics, and I would see it's either or combination of both. You can either have an increasing supply trend, so that means there's more and more property coming to the market. But when you're analyzing supply, you have to analyze the other side of the coin, which is demand. So you have to see whether demand is keeping pace. If demand is not keeping pace, and what that means is that you can look at it in terms of slope of different angles. If you have an increasing supply that has an angle of this and a demand that's flat, it's not reducing essentially in the same slope, that means it's not keeping pace. And I would also look at the recent supply introduction and recent days on market or vacancy rate behavior. If in the last 6 months, to a year, if we see days on market increasing substantially, jumping from a 25 or 35 to a 50 and then 50 every single month thereafter, you can see the demand is waning off. So there are a few tail signs, but essentially it comes down to the friction point of affordability and then looking at the supply and demand balance or imbalance.
And I guess this is kind of where that metric that we were talking about, because I think sometimes we've been talking to data, for many years, and property fanatics is you do not want to go to a market that has had exponential growth. Like it is logical. What I was talking about at the outset of the show, asking, this market's growing 50%. Is that our cutoff? No, it needs to be factored into the rest of it. So it's not getting too excited and saying, oh my gosh, we have to leave. But you don't want to go into a market where you hear people spruiking this whole thing like, oh my gosh, look how much growth it's had. It's had 100% growth in the last 3 years. It's going to continue. Well, no, the affordability, the people that live there have a low socioeconomic IR/SAD, which is IR/SAD, which we spoke about at the beginning of the show. Those people can no longer afford, and the prices hit that $800,000 threshold. Where can these people push these prices up? There is no affordability for these people to keep nudging that price beyond that 800,000.
Absolutely. And so I think it's very important for listeners and for everyone. And what helped me is to understand that just analyze your own life. Okay. Analyze your own life and your own behavior. And that's what data is. I go to Macca's every morning to buy a coffee at 8 a.m. I'm establishing a pattern. So you know what I'm doing. Now, when it comes to property, analyze how you spend money and what affects your spending patterns, and how you make decisions in relation to spending on Netflix or going out and watching a movie, etc., etc. We are very careful and consider the spending patterns for these small decisions, and that actually transpires to also bigger decisions as well. So you can imagine where the price ticket is $500K and not $20 for a movie, how it actually changes and how it affects everyone within that suburb. As I said, the best way to understand it is put yourself in their position or imagine that it's happening to you, and you'll understand how that's going to shift your behavior. And if you don't have, you need two cohorts participating in the market to see above average growth. So you need both owner, occupiers, and investors. Now, the balance shift depending on the price point. If we go higher to higher price points, 850 and above, we see more owner occupiers participating in the market. However, for that 600K, as I mentioned, you need both to see above average growth. And if the property is very expensive for its local residents, you'll see one cohort not participating as much, and that will dampen growth. As simple as that.
We see both.
What before we go,
that's right.
Yeah,
that's right. The knock-on effect. That's right.
Before we go to our sort of sponsor, I want to know how you think about areas where there's low mortgage sort of level. Do you look at sort of mortgage LVRs in areas? Because if you've got a $3 million area, which most people's probably not affordable, but I don't know if you can look where you look at LVR data. Let's say the LVR is 10%, and then you say they got a $300K mortgage on average for the area. So can you then still continue to see what drives can an area still grow if an LVR is low enough? Because then it's just people trading properties in the same area, or is that not reliable enough to look at?
Well, our affordability index takes into account median incomes, it takes into account typical values and interest rates plus a buffer, but we also allocate 50% of the household income towards repayments of mortgages. Okay, so we don't allocate 30, we allocate 50, simply because I think new research has indicated it's more 50, and I think Westpac has also published the research that coincides with that observation. So we allow 50. So obviously, the higher the spend on mortgages, the bigger the friction point there is, and that will be manifested in the index as well. So yes, it does play a role, but I also think that we shouldn't look at that in isolation. We should look at that, at their median wages as well, because LVR might be high, but they might have money sitting on the sidelines because their wages are high. So you need to again turn it into a ratio, contextualize it more, and just compound it with a bit more metrics there.
Okay, so I want to get into a little bit more physical, because we're talking about numbers, stats, data. It's just been our three stupid little faces in this thing. I want to get the platform up. You got a beautiful face there, Matt. Me and Jeff's stupid face. Yours is great.
No. I'm in the same group. Don't worry.
So I want to visualize what the heck we're talking about and kind of connect the dots on this. I also want to go back in time. I want to go back in time and look at a market that has done well. And you point to me and tell me, Joe, this is why this market did well, because it's all well and good to say this market in the next 3 years is going to do amazingly. This is awesome. And then be able to articulate that. I want to see, great, 3 years ago, this property market was doing this, which we'll do that after. Show us how to think about the data. And then if we could look back, I know I'm kind of springing you on this. We didn't plan this, but I get sick of people telling us how great data is. Yeah. And then, I'm not going to go back in time and prove my point. So I'm hoping that you can do that live on this podcast. Probably a little bit too big of an ask, but
you can.
Yeah, I hope so. And then I also want to jump. We have to. The crowd spoke. They want to see and understand the data a little bit more in Geelong. So we'll go into a suburb in Geelong, and then we'll jump into some questions, because man, we've been getting a lot thrown at us. So let's jump into our sponsor, and then we'll jump straight into that.
All right.
The amazing thing with commercial property investing is that in most cases, it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yield, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years' experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia. And not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
And we are back.
Let's do it.
Yo,
Yeah.
Let's do it. I'm
So,
excited, mate.
well done with
Sorry.
yeah. I'd love that you're able to sort of tackle most of the challenges that come your way. So shall we dive in? If you want to start sharing screen, let's, because we've been talking about all those data points. It'd be good for people to actually see them in. So if you're listening to podcasts, jump on our YouTube. I know people dislike when we do that, but that's okay. Jump on and have a look. It's a bit more visual, but we'll talk to it as much as we can. So if you
which
could
area?
share-
Well, where do people want to go? They want Geelong. So let's go over to Geelong, and let's say we've got there was a suburb that someone picked. I think was Bellpost Hill, was it?
I picked that because I think it's pretty. It's kind of a bit of a sweet spot. I feel people said Brisbane, so drop your comments where you want to investigate. We may have time for a special one, so let's go. It needs
to be suburb specific, not region specific.
Yeah. Pick your favorite suburb in Australia.
Am I sharing, guys?
Yeah,
you are now.
Okay, now we just click. Okay, so go onto the platform, and then we'll share your screen. I just don't want to share all the. Bray Park is where he wants. Okay, cool. Now we are seeing Bellpost Hill, but can you zoom in on the page?
Here you go, zooming. It's on his first. Interesting. So what are we all looking at here?
Zoom in so the map and the white box is at the edge of the screen overall. Not that map.
As in this, like that.
Yeah. Zoom that in heaps.
Yeah. So that's as much as it will go, I think. Actually.
Okay. Oh, there you go. Perfect. Yeah, good.
Yeah.
Good.
Yeah. So this is a standard suburb page. At the top you have the typical value, yields, information. I think everything has a narrative around it, so people need to understand what the metrics mean, etc. You have the RCS scores here, which is our algorithm for projection. It's a 5-year plus metric, and it says it has a very low risk, this area, i.e. it has a diversified industry and lack of exposure to negative environmental effects. Its capital growth score is 48. Let's say average is 50, I would say. Cash flow score is a bit better. It's 57. So I would say, just looking at the RCS, I would say that it's more, it's a stable area, and it will be better positioned for long-term buy and hold, as opposed to, now I have to look at the supply and demand dynamics, as opposed to like those quick kind of a substantial returns. You can expand. We have an AI narrative about this area, but I'm not going to go into it. I'm going to actually explain the metrics, which is much better than this AI narrative. So what do we have? Diversification index is 80 out of 100. As you can see, it's green. It's positive or opportunistic. No exposure. So economic diversity index is, I'll read it out. So it's an index that highlights the level of diversification of industry in a particular suburb. So the higher the index, the higher the value there, the more diversified the economy.
Okay. Makes sense. Yeah. So that's saying this economy hasn't got a mining town only. It's got many industries. But what this index is actually, it has an additional layer which is very useful. So it doesn't only take into account the diversification of industry, but also takes into account the socioeconomics of those diversified industries. So, for example, if you have 3 or 4 industries which you would say is a diversified town, but they're associated with very low socioeconomic standings, that still poses a risk. So the score would be lower. Right. Okay. That makes sense. That's super helpful. That's so much more valuable.
So see, it says the economic diversity index is diversified by employing a modified version on Shannon Weaver index algorithm to analyze employment data. This methodology quantifies the diversity of employment sectors within a region. Moreover, occupational categories commonly associated with elevated socioeconomic standings receive increased weightings.
And what's a good? I mean, I see that's in green for those listening along, and it's at an 80. So where does it sort of start to look particularly juicy? Like what range?
Yeah, so we have a data dictionary on our page which provides you with ranges. I think from memory around 70. 70 would be orange, so that would be sort of neutral. I think you start going into red, 50 and below. But I think above 70 would be green. From memory, don't quote me. I'll have to refer back to the ranges.
Yeah. Okay. Yeah. So no bushfire risk, no flood risk whatsoever.
No bushfire, no flood risk. School rank, so it's 58. It's from a score to 100. So it's essentially a school rank public schooling system, which is pulled from NAPLAN and ACARA databases. It's from 100. Now, it's very rare to see a public schooling system at 100. I think the highest we see in the 70s mark. So it's not too bad. It's neutral. We see, and this is important for owner-occupier demand, by the way, but I mean, in the hierarchy of significance, out of 10, it will potentially be a 6. And when I say in the hierarchy of significance, I refer to that in terms of correlation to growth. We have infrastructure spending, but this is per capita. So it's 2,743, which is extremely elevated, which is phenomenal. It's great. So that means that there's a lot of building going on. Again, it's a positive. And when I analyze suburb pages, when I go through it, just imagine you're going through and you're giving a tick or a cross at every metric. At the moment, we don't have a cross essentially because all of them are positive, but this one we deserve a double tick essentially because they're obviously building and spending a lot on infrastructure in the suburb. Now, a little, I guess,
long overall, or like how do you determine
these suburbs specifically?
Well, what are they doing in that suburb specifically? Because
so I have to pull from the data set to see, but it's essentially pulled from ABS and different other sources. We have a data set in the background, so I can post all the projects that are doing, but it's essentially non-residential building approvals such as education, healthcare, aged care, transport, and other buildings.
Right. Are you just reading from the list? Yeah. Okay. Cool. So that's so 2,700 per capita, and this is what you talk about doing it for a ratio, because then it doesn't matter how many people. If there's 100,000 people and they're spending, $1 million, that's not really as good as if there's 50 people and they're spending $1 million, right?
Absolutely.
Nice. And double tick. So far, so good.
And the last sentence there is also very important. And this is how you start creating narratives and connecting metrics. See, the last sentence says, this metric serves as a proxy indicator of infrastructure investment in any given area. Now, it's also a good precursor to population growth. So, but however, this needs to be combined with another metrics to establish a good precursor to population growth. It needs to be established with this. So if you have a very diversified industry, and it's not reliant on a single mining town, this means that these non-residential building approvals are not going towards supplementing for the project itself and around it when the government builds to actually enable the functioning of the project, but it's actually going towards building roads, bridges, and hospitals in a particular suburb, which are accommodating for population growth.
Yeah, right. Rather than shorter term, like somebody could be supplying
in a single mining town, you have a lot of infrastructure projects, but they most of the times are going primarily towards the operation of that project itself. Now, what I mean by operation, it will be roads, bridges, and all the other things that are accommodating for the project itself as opposed to population growth.
Yeah. So when people look at this platform, should they also then go and just have a quick Google around the local council or Infrastructure Australia to sort of see what type of things, like, or is there a way to do that on Hashtag? Like, how do people understand what those projects are?
Yeah. So we don't publish that data, but if people ask us, we can. We just provide a metric essentially, but they can always check. I mean, they can check and see whether the data corresponds, and this is why we have a customer service funnel that really we get all these questions all the time and they're answered by our team. So if there's any discrepancy, we provide answers as to why, but there was no complaints. Always sort of matches whatever is on Google or ABS or any other platforms.
So to find it, they would just it's always worthwhile just seeing what infrastructure projects are going on in the area anyway, as a part of your kind of research to understand.
Absolutely. Those that are using our data long term have already done all the checks. The checks, so they understand that its accuracy. and people that sort of email us will provide with the sources where we pull the data as well. So we have no issues with doing that. But yeah, we're big on transparency. But if guys want to check, they can either email us. I don't have it right here. It's not a metric that I can click and then open it up. But if they need to if they need to understand the information, we can always provide that via email or any other format.
Love it. I'm just kind of cautious of time here, so let's power on through some of these other trends. So one of the things that I'm initially noticing when I look at this data here is exactly what I was talking about before. And can you just zoom in a little bit more so it's kind of a bit blurry on the screen?
If I zoom in a bit more, it gets more blurry.
Yeah, you keep going.
So keep going like that, or keep going like this.
Yeah, that way. Yeah.
Yeah. Just so if I zoom in, it will get blurry though. So anyway,
that's fine. So 3 years, this area, like if I instantly look at this, 3 years, over the past 3 years, this place has lost money. So it's lost 6.5%. So if I bought a property for $500,000, I'm down. I'm down my stamp duty costs there. What do you think of that?
Well, again, if I look at only this now, I'm a big proponent of the contrarian investment thesis. So everything grows through cycles. And when I analyze the typical price, I analyze everything, including the growth patterns there. I can see that this is tapering off, but this doesn't mean negative. It can also be defined as provisional value because, the market is cooling off and there's potentially more value in the market to purchase. Now, what we see from the patterns, we see that the area has had more growth in the past and less growth in recent past. Distant past, so more growth in distant past, less growth in recent past. And because everything grows to cycles, if its supply and demand dynamics are correct, I'll take advantage of this counter cycle. So it tells me that this area can potentially start, and you can see it can potentially start or embark on another cycle of growth.
So what then triggers us to be excited about that trend? So right now you're saying, okay, cool, countercyclically, this looks like a market that might have some potential. How do we now know to say it's time to jump in? Let's rock and roll.
Yeah.
Or well, it's just going to be another 6% for another 3 years.
Yeah. So great question. So first, what I would do is I will go to the growth rate cycle. I want to see where it's in the position of the growth cycle, so we can see that it's actually at the bottom. I mean, it's going into negative growth, which is what we saw from these patterns here as well. So it's actually at the bottom of the cycle, and it's actually at the lowest point since 2009. So in the same way that nothing can grow indefinitely in value, nothing can also lose value indefinitely. So now going to Jeff's question before, if we want to time an entry, should we buy it now or should we wait until it exhibits a bit more negative growth and then potentially enter in 2025? Well, that question is answered from supply and demand dynamics. Okay, so I would look at the affordability index. Now you have ERSAT, but let's go first to see whether we should enter, and I'll come back to the other metrics. So I look at the affordability index. It's sitting at about 37.4 years to own. Now I'm going to scroll above a little. Sorry if people get head spins. I just want to see the typical value. 673. Considering its typical value, the area is not overly unaffordable for its residents. It's still within the affordable range. Now, although it's crossed the 30 threshold, it has passed it. Now, remember, our metric is years to own, and mortgage terms are 30 years, which is why we put the red line at 30 years. But the affordability index shifts on the basis of the price point. And we can see that it's actually below an overall trend, which is providing more value. So for properties that are between 550 and 850 in typical value, the index should sit anywhere between 40 years to own or less. For properties that are 550 and below, it should sit anywhere between 35 years to own or less. And now for the higher end of the market, for properties that are, or for areas that have a typical value of 850K and above, it should sit anywhere between 45 years to own or less. So using those analogies, it is within the affordable range. So that's a tick. So then I move forward, and this is not enough for me to understand whether I should enter the market. Yes, the macroeconomics are correct in the sense that it's affordable for the owner-occupier cohort, but I want to look at its supply and demand. And then I go to the supply and demand. Now, there are three domains of supply and demand that you can analyze. There is current values, there's short-term trends, and long-term trends. Yeah. So on this side, on the left-hand side, we see stock on market, inventory, building approvals, and hold periods. looking at the current values, they're all in the opportunistic range because we see they're green. So not a lot of building approvals are coming to the market, which will potentially dampen price growth in the next 2 years. Hold periods are nearly 11 years, which is substantial. It definitely signals livability and the people actually like to remain in the suburb. And it also restricts the future supply and separates it by 11 years of existing dwellings. Inventory is also low, sitting at 1.11 months, and stock on market only 7 listings at 0.31%. Now, to me, that's not sufficient. I mean, I like the fact that it's favorable, but I need to go into trend analysis. And what are we looking at? We're looking at a trend since 2020, and we see a slight overall reduction, only slight reduction in an overall trend, which is always a good sign. It means that the trend has started tilting to the downside and the supply is becoming more scarce. So I do prefer that. When it comes to the recent trend, if I look since 2023, we see a bit of an increase, but then a decrease. I would say if I average it out, it is essentially sitting at the trend, which is slightly reducing. So stock on market is okay. I would like to see a bigger nosedive to establish more scarcity, but I'm actually happy with the fact that it has current values that are preferable and also an overall trend that is reducing. If I move down to inventory, we see the same situation, a slight reduction in inventory. I would say that recent trend for inventory is probably reducing more than for the stock on market, only slightly. Building approval ratios, although the trend an overall trend seems to be increasing, we see only small amount of building approvals in recent times. And not only that, building approvals are very sporadic in the past. So I wouldn't place a higher weighting on the fact that this overall trend is increasing because it's sporadic and the trend is, I guess, poor. It's not as solid enough because there's not every month that we see building approvals introduced to the market. And then we go to hold periods. One negative about this chart is the fact that we see a lot of change in sentiment about the area. People like the area, then they don't. They do, then they don't. Then they do, then they don't. However, now it's sitting at 11 years, so current values are phenomenal, but there's a bit of change in sentiment about the area. Now, as I said before, a graph in itself doesn't mean anything. It is not implicitly good or bad. It is only good or bad in its comparison to another hold period graph under the same price point. But we're just now analyzing a single area. So I'm just telling you what I essentially look out for. However, looking at supply is not sufficient. We have to establish the demand side. So I go towards the days on market. Now, what is concerning here for me is that the reduction in supply is not as forceful as the weakening effect in demand. Sorry, is less forceful. So there's less reduction in supply, then the demand is actually weakening more. So demand is not going to, there's not sufficient demand to actually cause price growth and establish further scarcity in supply. We see days on market sitting at 47 days, which is neutral. However, the overall trend is increasing, and I would say even the recent trend in days on market is increasing. If I compare it to this period here, from 2020, let's say, to 2022, it is essentially was sitting below trend. So essentially, we see now the tilting of trend, and this is what I said to you before. If we were now back in 2029, and we were looking at only this portion of the graph, the trend would actually be reducing, yeah? But now, then after 2020, we started to see days on market actually increasing, which has started to shift this trend to the upside, which means that demand is becoming weaker and weaker. What I would like to see in a good market and a market that I would like to enter is I would like to see a reduction in supply. It can be as minimal as this, but I would like to see at least good nosedive in recent days on market. So this part of the chart, I would like to see the bars at least.
Okay. So that's a bit of an amber flag for the area.
Correct. And now, if I had to go back and see how there's no perfect alignment there's no perfection in an area, and we specifically now saw that from a single metric, you can't make a decision. Now, if I looked at affordability alone, I would say, okay, great, I'm entering. But then if I go further down and I look at the supply and demand dynamics, I would say that demand is not strong enough to absorb the supply and actually increase its scarcity. So if I had to time the entry, I would actually wait it out potentially as the GRC stipulates and enter at 2025.
Oh, I tell you what though, Mattia, what I'm hearing and seeing though is if you can get a deal at a great price, you can even sort of start to, and that's where I suppose it comes back to the, I know
phenomenal. phenomenal interjection. I love that you said that. I completely agree. You make money when you buy also. And if you can negotiate, sorry to cut you off. I'm just excited about what you said. If you can, if you can, absolutely. And see, there are different ways to make money. You don't have to make money from market momentum alone. You can make money by going into a market that is not actually desirable. The fact that it's actually sitting, let's look at discounting. So we see this scatter plot. The discounting actually hasn't been happening recently, which is actually a good sign. And we see the last couple of DOMs actually being below the trend, which is also a good sign. So you potentially can enter a market now. The fact that it's sitting 47 days on market, if you're a good negotiator, you can negotiate the property down. And that's also equity.
Yeah, exactly. So if you can buy a $500,000 property that's below $50,000, that's 10% that you've instantly made on your investment because you can negotiate in it.
Yeah. And then who cares if you're sitting on the sidelines for another 3 years for this to start pumping?
3 years. Yep. I thought you said it was going to be a year.
No, I'm saying I would enter at a year because it would be at the bottom and then it will start. But I'm saying pumping, above average returns.
Pumping. Okay. Yep.
As in plus 10. Sorry, I'm using crypto analogy, but I'm saying, hotspot, becoming a hotspot.
Yeah. All right.
Yeah.
So I think that's an area of potential opportunity. But let's throw. I was going to go to Mount Gambier, but I think otherwise we'll be here for.
Yeah, we're going to be here forever.
Let's do an area. So as Joe said, we want to pick an area that's done quite well. So is that a Townsville? Are we going to WA? Are we going to
let's go to WA because I think that this will talk to an area that's pumped and done really well. So let's go to a suburb called Hillman, HIL. Yeah, Hillman.
I told you about that one. Jeez, Hillman.
I think we did a session about 2.5 years ago. So if you guys listened to that and bought the property the properties and locations, you would have done. You would have made about $200,000. But
Butler. Somebody wanted to talk Butler. Yeah, that's interesting.
Okay, so let's zoom in. We'll move our little silly faces out the way. Okay, cool. So one of the things that I wanted to talk to on Hillman was that capital growth story and kind of how could we see that this market was going to do well? Because if you scroll down just a little bit, Matt, you'll see the last 3 years have been exceptional. Just go drop down 96%. So we've had 96% growth in the last 3 years. Which is
essentially doubled in 3 years.
Yeah, ridiculous. So let's just do the opposite, but let's just pretend we don't have the data going forward. How could we see that this market was going to do so well?
Well, I don't like this market for long-term investing, personally.
Mm-hmm.
So just to throw a spanner in the works. For short-term, I do like it. Short term, how did you know? Well, it would have to be for short term, which is 3 years. And those people who made 100% return in 3 years, they can exit now and they made a substantial return. Now, how did you know? You knew from supply and demand dynamics and affordability, short term. Now, the fact that it's sitting at 45, so 3 years ago, in 2021, it was extremely affordable. It was sitting at 17.1 years to own. Now it's 45.
Went below trend as well. If you look at that,
so imagine look at the actual. This is why I'm saying I wouldn't like it long term. I mean, if you enter now, because I actually seen from the growth patterns, and I know this area. I know that it's very unaffordable now for its residents. You're getting a friction point now. If you entered 3 years ago, it was extremely affordable. Okay, so it was 17.1 years to own. Remember, now we're looking at. Geelong area that was sitting at 35. What was the price point here? What's the price point now? 650.
Is it?
So
Jesus.
Yeah, so it's 650 now. So again, look at the comparison. The Geelong area that we were looking at is 650 as well. However, its affordability index is around 35. This one is 10 years to own more than the other Geelong area, which means that there's a higher friction point there, especially when its ERSAD is 1. So it has a very low socioeconomic standard. So it's very onerous for its residents and owner-occupiers moving forward. Now, it wasn't 3 years ago when it was at around 17 or 16. Moving further down.
Yeah, green flag, exciting times, great. 17 years to own, happy days, the people that can afford to push the prices up.
Correct. Now, moving further down, if you see its slope in let's say 3 years ago, it is nosediving. So that means that the demand was increasing substantially. Remember the slope of the other town, what was the other name of the other town we're looking at in Geelong? I forgot now. Yeah, that's right. So remember its overall trend. Its overall trend was increasing. This one is actually taking a substantial nosedive. So the angle in the reduction of the DOM is substantial, which means that the demand is increasing. And see what I mean by, in this instance, in the other instance, we had a reducing supply, but a very, very weak demand, which couldn't take advantage of the reduced supply. In this instance, we have a supply that 3 years ago was semi-flat or even increasing, I would say. However, its demand was rampant. So the demand was even absorbing that increased supply, and combined with the affordability of 17 years to own, this is why you saw the pump. This is why it turned into a hotspot. Now, that's looking only in stock on market and days on market. Let's look at inventory. Inventory is actually reducing even further, and it was reducing 3 years ago. Building approvals, there was none or minor. Hold periods are sitting at 11 years. 3 years ago, that was sitting at 9, which is also substantial. It's essentially above one property cycle. So overall, if I look at its supply side, 3 years ago, it was at the equilibrium. However, its demand was extremely rampant.
Yeah.
3 years ago, the vacancy rate was actually dropping. Its overall trend was dropping, and you had a substantial reduction in the days on market, and you had an affordable area. Bingo. There you go for that.
The only thing that slightly concerns me about trying to, because how do you then sort of, how long do you need to track something? Do you like to see 3 to 6 months? And like, how do you then, or do you just start chatting to the ground to sort of see what they're
just look at the trend and separate the trend into recent and long term. Again, because property is a liquid asset, the changes of the trend. Now let's go to the Geelong area. I want to show you. I keep on forgetting its name. I don't know why. Anyway, so I want to show you the trend reversion and how it actually unfolds in a real data set. So Jeff, if I look at 2021, we see 1 days on market sitting in 123 days, but most of the other ones are very low. So if you had to draw a trend line, it will actually be reducing. Yeah.
Yeah.
Do you understand what I mean?
Yep. Yep.
Now, from 2021, specifically 2022 February, let's say, you start seeing gradual increases in days on market. And see, because of this middle section here, which was lasting exactly a year, you saw a shift in trend, and it actually started increasing. It started going upwards.
Yep.
So if you looked at just this part of the graph, it will be nosediving, or it will be reducing, and then the days on market starts increasing, and starts shifting the trend. So to answer your question, you don't have to have alerts essentially on your phone to know what the days on market is currently in the area, to know whether you're going to make a decision. Just look at the short-term trend, i.e. a trend within a year, and see if there are substantial changes which could definitely impact a shift or create a shift.
Well, that's awesome. So what you're talking about kind of proves the point, and you can see the capital growth. So this was a market that you would have entered in for a short-term jump in, jump out.
I would, but I wouldn't hold it now indefinitely.
You would take your money and run, and then move that. I mean, there's obviously transactions costs involved in that. We've got stamp.
Absolutely. But think about this. Think about this. What is the opportunity cost? So if you made 100% return in 3 years, that's unheard of. So your pick was phenomenal. But then what is the opportunity cost of me holding onto that money as opposed to leveraging somewhere elsewhere where it has much better long-term stability?
Yeah.
Exactly. I'll let Joe decide on this one. The crowd is asking for one more. Do we have? I don't know. I'll leave it to Joe and Paul.
Well, I think we need to do another session.
I think your pick, Joe. I think your pick, Joe, was phenomenal actually, because those returns in 3 years, doubling, it's unheard of.
Yeah. You can thank me and Jeff, everyone, if you guys actually took action on that one.
Why didn't you tell me about it? I should have known.
We also did a session on Townsville in probably, what was that? I don't know, it was probably mid 2022, probably as well, or mid to, I don't know when exactly it was, and that's that was a good little that was
so
when
we stopped sharing the stream, Matt, by the way, so you can get off that if you.
Me?
Yeah.
But so I want to know. So let's get to some questions. There have been some questions come through because and this is a great one from Jen because he said 40 days on market is already low. Does a flat trend make any difference? Like, how do you kind of digest that? Because he's saying 40s. I mean, it's not crazy low, but it's low enough. Do you then sort of does a trend make any difference? I mean, probably yes. Apparently.
I sort of don't understand the question. So is the gentleman asking whether 40 days on market for the current month, if you know that, do you even care about the trend? Is that the question?
Yeah, well, it's like 40 is so low. Does the trend matter? Like, it's already at a really low number. But for me, 40 is not a super low number. It needs to be something like 20 is about as low.
Yeah, me neither. It's not super low, but it's neutral, I would say. It's sort of, the trend is always important because you want to understand the force of the direction and how long it's going to last into the future. So the trend is always important. The more forceful the nosedive, the more you can infer that it will continue into the future because it will take longer for the shift to occur.
Yeah, and you can't rely on a standard metric. If you look at that Bell Post Hill example that we brought up, there was one there that was like at 90 days on market, and then there was another one that was at 23 days on market, and it's like, oh my gosh, buy this location right now. It's at 23 days. No, it's now at 90. Oh shit, this is the worst experience of my life. So you got to kind of look at the trend to really analyze.
If you arrange it, what was the gentleman's name? Was
Jen.
Yeah, Jen. So it was a lady. Yeah. So if you had to, is it a lady or a guy?
Yeah, I know because I look at he's a regular on our Facebook group. That's why I know.
Yeah, it doesn't matter. Anyway, it doesn't matter. Yeah. What I was about to say. So in a hierarchy of significance, if you want to layer it, long-term trend is more important. Short-term trend is a bit less important, and then the least important would be the current value for the month. And you're layering it depending on the force of the direction. So long-term trend always has a bigger force of direction. Then it's short-term trend. And when you're filtering on our platform, you're layering it in the same way to establish scarcity.
That makes sense. It's about putting it all in, putting all the data together like a jigsaw puzzle. Because otherwise, if you're just looking at anything in isolation, it could look great, but then you just missed. And the other thing that Joe loves to talk about, and we both love to talk about, is the boots on the ground. So this is my kind of first love to look at the data, sort of understand my budget. So my hierarchy of looking at it, I look at budget. Okay, what can I afford? Speaking of a broker, and what do I need in my portfolio? That's great. Now I know my parameters. There's no point me looking in Mossman for if I've got a budget of 800K. Unless you're looking at units, maybe you pick someone up to that price, but you're buying a unit in Mossman, maybe could go okay, whatever. And then you sort of say, okay, data ticks that box, and then I go to my next kind of criteria, which is speaking to the agents, speaking to property managers, understanding what's actually happening. Can I get a good deal? Because if I can get a deal, if it doesn't look fantastic.
Awesome question that's come up here from Winnie. I think, Winnie, we're having a conversation tomorrow, I think. There you go. Unless it's someone else, not many Winnies in the world. A real famous one. How do you treat suburbs where there is an insufficient volume of data for us to analyze? Do you just never touch those suburbs, or do you rely on boots on the ground? How do you that's a great question.
Yeah, it is a great question. I mean, on our platform, we separate the database into three different domains: high confidence, medium, and low confidence. And essentially, it's related to the volume of sales. The reason why it becomes dangerous to address data sets that have lower volume of sales is because the oscillation in metrics are dramatic. So as Joe has pointed out, you might have a days on market that's 25 today, and then tomorrow it's 250. Why? Because, not tomorrow, sorry. The next month and the next 3 months. And sometimes you don't even have a recorded days on market upon which you can establish a pattern. And this relates back to, again, your investment time horizon and your strategy. If your investment time horizon is long-term, you need to eliminate as much risk as possible in order to inadvertently increase the probability of an outcome. So if I'm stuck on a deserted island and there's only one suburb I can buy in and has low confidence, well, I'll go and I'll do it. However, if you have 50 different examples that are not low confidence, I ignore it, I shelve it. Now, if your investment strategy is to flip a property, to renovate, the fact that it has low confidence and you still believe that you can sell it, then the discourse changes. But as long as your investment time horizons are long term, it should be prudent to actually approach a data set in a way that you're not introducing an additional level of uncertainty and complexity that you don't need. So the answer is yes, I would stay away from them if my investment time horizon is long term, and I would stay away from them simply because of the unpredictability of those areas, but also secondly because there are definitely areas that have higher volumes of sales and higher data confidence that I can choose.
Yeah. Just gives you that little extra peace of mind knowing that you've chosen an area that where you can actually statistically heighten that probability of success.
Because otherwise, the challenge you run into, there's probably going to be, depending on your budget, you could have anywhere between 10 to 20, maybe up to 30 suburbs that are going to fit the brief. And are you then going to sort of pick a suburb that are high confidence? So would you then go for a suburb that's low or medium over ones that have greater statistical reliability and statistics?
I do a bit of a thought experiment with our community. I get let's say DMs from our members. And they say, Matt, what do you think about this suburb? And I always say, what are the other options? I force them to understand that I don't want to speak about a single suburb. Well, I first ask, what is your brief? And then second, what are the other options? And they okay, I know what you mean. Okay, this is the short list. And then the story completely changes.
Nice. I think we might already know, not to tarnish a whole area, a whole state.
Does Matt still love Perth? Yeah. Yeah, so by saying still, that means I loved it before. No, I'm kidding. No, again, when I always talk about an area, I talk about in terms of brief and in terms of timeframes. I was saying at a certain point that I wouldn't be in certain suburbs in Perth because I was talking. And Joe, remember our first discussion on the phone when you and I spoke. Can you recall? He gave me a call and was talking about data sets and Perth, and anyway, it doesn't matter. I remember. It was a great conversation. It's sort of tattooed in my mind. So I always think of terms of time frame and stability. So I never say whether an area is good or bad. I'm thinking, okay, what is the brief? How long will I stay in the market? And then I analyze its past. I analyze its past patterns and past behavior to determine its future stability potentially, or just increase the probability. So Perth might have great potential for short term, and it has highlighted that. I mean, short term, 4 years is not a short term. You've generated substantial returns, and we just saw you've doubled your investment within the 3 years. But then my next question is, okay, will that area that we're looking at, is it better stability in stability terms for the next 10 or 15 years in comparison to other suburbs? And I can definitely say there are better options that are outside of Perth. So I try to stay away from, and this is the usual trend online. We're all fighting, we're proponents of a single area or not. I want to discourage that. I think it's important to understand every area is different under different brief and investment time horizon. If I'm talking about stability and long term, I will pick other states over Perth. If I'm talking about short term, Perth was definitely winning the race. So it all depends. It's horses for courses, essentially.
Mate, this has been an unreal session. I think that what I usually do is I listen to podcasts and I put it on 1.5 and 2 times speed. I think with you, I'm not going to do that. I'm going to set it down to like half a speed and kind of just listen in. There's no slow feature on you. So people just need to rewind and go back and listen to some of those points because you go really fast and you have so much value and you just need to soak it up. You guys have been gracious enough to give our community access to the platform with a 20% discount, I think. Can you just go through, because I'm looking at the pricing section, like the way I think about the way I think about this is you're spending $500,000. If you're not going to do this yourself and use, if you're not going to use a buyer's agent and to help you do all this stuff for you, you should definitely invest in substantial amount of data to be able to work out your area. So what's the go with these 2 plans? And what do you reckon's best for an everyday Aussie investor? And how do they get access to this 20%?
Yeah, so you use Oz Prop code, which I can share to you guys, and you can distribute it to the community. And they think they get 20%, and they also get 20% not only on the initial term but all the subsequent terms. Let's say if they subscribe for a month,
really?
It'll be ongoing kind of thing. It'll be ongoing kind of thing until they cancel. So it will be one, and I think the best plan for investors will be the investor plan, because there's a certain attachment in the professional plan that they don't have to pay for, and it's unnecessary for them. The plan also does not only, you don't only get access to the platform, but you also get access to our mastermind community, and I'm the coach there. So I provide one-on-one tailoring feedback and coaching for people to get to a certain level to analyze data and make the best decisions. So it's not only the platform, it also comes with the community currently at no extra cost. So when you subscribe, you also inadvertently get access to the mastermind community for free currently. We might be changing that in the future, but for now, it's, you know, you get that substantial support and coaching as well.
Okay, cool. So then what do? We hit, sorry, join now.
There was a question on which screens do we show today. I think that was would be the investor would cover it, wouldn't it?
Yeah.
Yeah, so you hit join now, and then you type in, once you get down here, scroll down to if you want a monthly plan, which is $149.95 for a month, or 6 months, already has then a discount, and then you go Oz Prop, and then you hit apply, and then you get your discount code. That's pretty cool, man. So instead of being $720, it's $575. Thank you very much. That's really cool of you guys to do that.
So it's essentially less than $100 a month. And when you really think about it in the context of your decision, that works out to be less than a coffee a day, you know?
Everyone loves that.
I have 2 coffees a day, but I make mine at home, so I'm probably the exception.
I have 10 coffees a day, so yeah.
You and McDonald's.
It's hard to buy a property these days.
Yeah.
That's awesome. So the investor plan's the best one. Don't bother with the other one. It's more for buyers agents to get access to reports. And stuff like
correct. Yeah.
That's
and I want to do some more suburbs. Like I want to sort of pick up. Yeah, there's so many. I wanted to ask about Darwin as well, but we'll. I've got some potential content in this. I just have to pick up the phone and actually call some people up that way. But stay tuned, people. We will be investigating sort of different parts of Australia. But no, I really appreciate all the. What's your? Here we go. Let's just ask this question and we'll do the wrap up.
End on this question. What is your favorite book on that shelf?
Oh.
Looks like
Being and Time by Martin Heidegger.
Oh, okay.
Being and Time.
Is that a science book?
It's philosophy.
Oh, philosophy. Okay.
Phenomenology. Sorry. Well, which is a branch of philosophy. Anyway, doesn't matter. But it's a German writer. I like that one. Essentially, most of my books are about that. I like to read and just take about 7 days to understand the page.
Yeah.
Wow.
Yeah. I think that's the fourth hardest. I think that's the fourth hardest book in the world to read. And it was hard. And I'm not saying that I'm smart to read it. It just took me a long, long time to understand what it says or what it means.
Well, here we go. Somebody's asking. Keep asking the questions. Yeah. No, otherwise,
okay. Let's head off.
Joe's done. He needs sleep. So, Joe, ask the standard question, man. How do we get more Matt here?
How do we get more Matt in our life, mate? Thank you very much for sharing those insights. So if people want to learn more, how do we connect? How do we get more Matt? If they want to use the platform, use that OzProp code on that link we just shared. But yeah, how do we get more Matt in our life?
Yeah, so thanks. That's an interesting question. No, I mean, we have a Facebook group, Data Driven Property Investing. People can DM me on Messenger. When people subscribe, they also get access to the mastermind community, and they get access to me on a daily basis. So essentially those three, Messenger, Facebook group, and the mastermind, essentially.
Love it. And this has been a really insightful chat. I really love the myth busting that you did in this session. There's a lot of data metrics things that people have out there, and you really just torn a hole in a lot of those and made people realize that it's not that easy to do this whole data thing, but it's not that difficult either.
Absolutely. I agree with that. I agree with that observation. It's not easy, but it's not hard as well. And I think I was always it's important for me I was always a big proponent of people believing in themselves that they can actually do it. And I think the fact that, you're spending $500,000 to $1 million, I think it's very important to invest the time to learn. It will take you a week. And once you do, you can really take care of your financial future. So, and I get a lot of people who are, they get stuck and overwhelmed by the data. There is a system and a process, and if you follow it, you'll be fine.
Yeah, I feel like we've just touched a service, but it's a service for people to. What was the demo including Archistar? That's all right. I don't think it does. I think that was a little bit extra, but I think people can check that out. But I think that's important. We've touched the data service. We've touched the tip of the iceberg, and there's always more to keep learning. So we'll have to keep the conversation going. So I think the
offer is not valid for very long. As far as I know, it's not active. So it'll be active for the next week or 2 weeks, maybe. We'll see.
Yeah. I said it at a fortnight.
Okay. You got 2 weeks. Well, thank you for that anyway. So if you guys are keen,
I appreciate it.
And then you're grandfathered in at that discounted rate going forward. Is that right?
Correct. So we really appreciate loyalty. If people continue subscribing, they remain on the same rate. And we don't any price. And we're going through a price increase, by the way, 3rd of December. So we still have members that are on a $50 a month plan.
Jeez.
Well, that makes me feel good about spending 150 now.
Well, we've been operating for 6 years. You know what I mean?
Yeah, of course. I get you. I'm kidding. But no, well worth checking it out. You guys need to get your head around all this data and stuff like that, mate. This has been unreal, guys. Let's go buy a property. Let's go find a data-driven investment asset. Good luck.
Thank you for having me. It was great. It was phenomenal. Really appreciate it.
You're amazing.